Good evening, good morning, good afternoon, good whatever time of day you have. This is Sid at Elliott Wave Plus, and this is the July 18 of 2024 edition of our quarterly premium plan webinar, where I will be going over all of my Elliott Wave counts and associated Fibonacci price targets for many of the world's major stock markets, commodities, currencies, and bonds. And I will also be showing you a lot of the nuts and bolts of our premium plan. Our premium plan includes automated momentum algo signals on about 24 items. We also have proprietary sentiment screenshots, both on daily and weekly charts that are extremely informative inside the premium plan. And so we'll be going over all of that. I just re-optimized all of the algos uh, for the last 3 years running. And I'm going to show you the equity curves of how those algos theoretically would have done had the current settings been in place over the past 3 years on about 24 items. And I'll show you a sortable spreadsheet that sorts each of our algos by theoretical results over the last 3 years based on a 3-year return on investment. And I'll be showing you lots of stuff. So please stay tuned for all of that. Before we get started, I'd like for you to be aware of my disclaimer. It's at my website, elliottwaveplus.com. To read my disclaimer, please go to the site, scroll to the bottom of any page there, and click on this Terms of Service Disclaimer tab. And please go there and read that in full. If I were to summarize it in one sentence, it would be there's risk of loss in all trading. So I'm going to bring up kind of a agenda for today's webinar, and I'm going to turn off the video of myself till closer to the end of the webinar. So we'll be back here with the video later. So my plan today, and this was kind of a list I put together for myself, just so I can stay on track, is I want to show you our pricing page so you can get a quick overview of our services, our service levels. That'll just take a few seconds, and I'll give you a link to where you can find that at my site. And then we're going to move on to our new weekly sentiment charts. I've had daily sentiment conditions charts for premium plan subscribers for several years. And I've developed a new weekly template on it that I believe is easier to read and really helps traders narrow down which items would be the best ones to trade right now. And we'll show you how that works. And we'll also show you after the sentiment charts, we'll show you the daily trend charts. By the way, all paying tiers get our daily trend charts, all four of our price tiers. And also our AMA daily momentum algo screenshots. We've got about 24 algos running all the time on the most popular traded items. We'll show you what those are and how they were designed, and then we'll show you how they theoretically performed over the last 3 years. We'll sort the results and see which ones have been doing the best. When it comes to momentum algos, the items that have a tendency to trend smoothly are usually the ones that do the best over a period of time. The ones that spend a lot of time chopping incessantly sideways usually are terrible for momentum algos, and we'll talk about that. Um, and then once I explain all of those things, and hopefully I can get all of that done pretty quickly, I'll start with the Dow Jones Industrial Average and move through the S&P, NASDAQ, and Russell and show you my multi-time frame wave counts and the algos, the sentiments, screenshots on both weekly and daily, the daily trends on those, and I'll basically be flowing through that period as if this was a weekly counts webinar. So for Pro Plan and Premium Plan subscribers, by the way, here's the pricing page at my site, and it's elliottwayplus.com/pricing if you have trouble finding it. So I have 4 price tiers. And just very quickly, every night, Monday through Friday, you get our daily trend reports. There's no Elliott wave at all on those. It just simply shows you what the daily trend direction is on about a dozen popular items, slightly more than that. And we also, in that tier, provide algo trade signals on the 4 most popularly traded cryptos. And we also show my Elliott wave, my combined Elliott wave and cycle analysis roadmaps, wave counts on Bitcoin, both on a weekly and a daily chart. So that's 25 a month. And I will say that many subscribers find these daily trend reports actually tradable. And we'll show you that here in a second, even though there's no Elliott wave counts on it. Then for $70 a month, you get all of that. Plus, on Wednesdays and on Fridays, you get my Elliott wave, multi-time frame Elliott wave counts on about 20 popular tradable items. That's going to include things like the U.S. stock market, crude oil, the U.S. dollar, the euro, bonds, and gold, silver, the most popular items. So you get the actual wave counts and Fibonacci price targets at that level, plus everything that was in the previous level. Then for $100 a month, we include all of that, plus a weekly counts webinar. So that's the thing I'm going to kind of mimic this time for you, as if we were in and I'll do the U.S. stock markets. And I'll just kind of roll like it's a regular weekly webinar, so you can see what those Sunday morning webinars, they're usually about 3 hours long, show you what those are like. Now, if you don't like webinars, that doesn't mean you can't utilize that service, because at my website, even if you don't like webinars or wasting 3 hours watching a webinar on the weekend, once it's done, we put the recording of it up. The straight Zoom recording, but then we also put a Wistia recording of it where we put chapters on it, so you can jump straight to my coverage of specific items that might be of the most interest for you. So you don't have to sit through 3-hour webinars to benefit from the weekend 3-hour counts webinars. And then for $200 a month, you get all of that, everything to the left, plus you get the algos and you get the sentiment. So that's very quickly, I wanted to show you what was involved at each of the levels before we start going through some things. And I'll try to remind you when I show you certain things at which level that that particular item I'm showing you is involved with. A lot of it's going to be involved with the premium plan. So let's bring over the, I want to show you the weekly sentiment chart. So these weekly sentiments, we're going to get rid of that. I took screenshots just tonight of 2 dozen items that we keep weekly sentiments uh, um, templates going on them. And I'm going to go through all of them right now. I'm going to show you how easy these are to read. These are featured every Monday for premium plan subscribers. Sometimes during the weekly webinar for Pro Plan members, I will show these, especially at critical junctures. And so I wanted to show you how to read these. So here's the commercials positioning. Commercials positioning. So in the case of, for instance, a commodity, a commercial is any entity whose um, business entails producing that commodity or selling it, marketing it. So a real example, a good example I would give for commercials would be gold miners. So in the case of gold, when we look at commercials positioning, we're looking at what the actual mining companies, how their trading departments um, are positioned. This is extremely important because if I had a medium or large size gold mining company that I owned, I would need a large futures trading account so that I could use it to hedge in case gold price went down substantially. So if I thought gold was going to go down and I produced gold and sold it for a living, I would want to be short gold in order to offset the fact that I was going to have to sell that commodity for less over the next X period of time. So that's called hedging. It was really the original reason that the trading exchanges came into existence is that farmers, like if I was a wheat farmer, I'd want to go and sell my wheat at market, and I might sell it ahead of time for a fixed price that I knew I could make money on. But if I was afraid it was going to be a bad year, bad weather, or whatever, I could short wheat in the trading market in order to offset the losses. In other words, I could make money as the price of wheat went down in my hedging account at the same time as my wheat crops were not doing well in the fields. That was the original idea behind these exchanges that we all trade today. So what this indicator right here is commercials positioning as it relates to their most bullish and bearish positioning over the last 12 months. So right now, commercials on the Australian dollar are heavily short. Now you might say, well, who are the commercials on the Australian dollar? Well, they'd mainly be large banks. Large banks. Large banks have trading departments. They've hedged their interests in the markets, and their profitability is directly tied to movements in currencies. So those would be, and central banks also might be involved. But anyway, right at the moment, commercials are heavily short the Australian dollar. They're as short as they have been at any point in the last 12 months. And when this indicator is green, that means they're heavily long the Australian dollar, and they're as long as they have been in at any point in the last 12 months. So, and then this next indicator down is the daily sentiment index. This basically runs on a scale from 0 to 100. So, if right now, very recently, 82% of retail traders were bullish, positioned bullishly on the Australian dollar. So what this template does is it compares the commercial positioning versus the retail positioning. And you can see that over time, there are critical junctures where when commercials are heavily, well, let's just take this for instance right here. Commercials were heavily short right here. So the Australian dollar had been moving up very strongly, and that's actually out of the uh, October of 2023 low. October of 2023. So the Australian dollar had been moving up. So what commercials do is they expect that when something has trended up pretty strongly for a while, they will start fading the move. They'll position against it, knowing that so their whole trading methodology is that they expect a reversion to the mean. They expect that the price of anything is going to move from overbought back to oversold over time, and it's going to run like that. So as this went up, they started building positions against the Australian dollar. This is at the same time that retail traders who are trend followers were just getting more and more giddy about thinking that the Australian dollar was just going to continue higher, for forever. And when there are extremes in sentiment on retail positioning versus commercial positioning, that is what this template points out. And these almost can be traded. These times where commercials are heavily short and retail is heavily long. And what that means almost every time is that commercials are going to be right. Retail is almost always way over on the wrong side of a boat at trend changes. So if the trend's been going up, retail gets very, very bullish toward the end of the trend, and almost all of retail traders are bullish toward the end of trends at the same time as commercials have been building positions against that trend. So it's the commercials that end up being right. This is all based on some of the concepts that Larry Williams, one of the greatest and most successful traders of all time, has written about many times in his many books, is that trade against the commercials at your own peril. And so that created what we call that here is a perfect storm. It created a perfect storm of bearishness. So when that occurs, I will put a manual label at that exact point. As a matter of fact, when you're in a thick red box here, that means commercials are heavily short. And when you get a red candle inside of that box, the first red candle inside of that box, generally, that means that the 3-period moving average of the daily sentiment index has started sloping down. So the slope of that moving average is the color of the candles. And so just like we had a perfect storm of bearishness right there, everything came down, and right here, commercials were heavily long, retail was heavily short, and there was a big green candle down here. These little green triangles here meant that the daily sentiment index was below 15. And we got a green candle down in this low zone, and that created this move to the upside. But right at the moment, the spread between the commercials and retail is bearish. So this is, matter of fact, this is the candle that's currently being formed this week. And it's the first red candle inside of a red box. While retail is heavily long, commercial is heavily short. That is a bearish condition. I got to tell you, there's a lot of professional traders that don't use Elliott Wave. They don't use cycle analysis, but they use this. They use sentiment and use it just like this. So that's the Australian dollar. Let's what we're going to do here is we're going to flip through all of the current weekly sentiment conditions templates that we provide screenshots to premium plan members of and occasionally show in our weekly webinars. We're going to show them all very quickly and just going to make some notes on what's bullish and what's bearish. Okay, so here's bonds. Can anyone tell me, are bonds bullish right now? Or are they bearish? And I'll represent to you that the current percentage of retail traders that are bullish is 72%. So pretty bullish, not super extreme. And commercials are bearish. So would anyone like to offer up in the chat what that means for bonds? Correctly, it's a bearish spread. Now, I think that's going to flip pretty quick to bullish, but right now it's early. It's a little early. So, and the thing that's the most concerning about it is the commercials are hedged bonds still. So they are not positioned for a big up move in bonds quite yet. I think they'll get there. And when they get there, our premium plan members are going to know it, because this will get up into the green zone. At that point, commercials will be bullish, and retail will probably drop back, into lower posture. And what that would require is a move down next, and we'll end up. We might be able to show that to you on bonds, but on my, I can tell you, I'll represent to you that on my cycles work and combined Elliott wave and cycles, I think bonds are generally bullish, and that means yields are going to be coming down. But it's a 1-2-1-2 setup where it needs to finish another wave 2 setup over here into August. So it's not in the perfect position yet. This is the 10-year bonds. That last one was the 30-year. This is the 10-year. Notice commercials are short. It's pretty much the same deal. So it's not in a perfect position to take off quite yet. British pound. Notice commercials are heavily short. Retail is at a 66, not super high, but overall, I'd have to say that this is not bullish. It's more bearish than bullish right now. Canadian dollar. Now, this is bullish because commercials are positioned heavily long, and retail is recently off of a 10. Only 10% of retail traders are bullish the Canadian dollar in April of this year. So what was going on right here? Well, commercials all of a sudden shot up and they decided that the Canadian dollar had dropped enough, and they wanted to take off all their hedges and be long of it. Whereas retail, the DSI actually got into single digits of 5. This also gives me an opportunity to tell you about this third indicator. This is the money flow index versus RSI indicator. Money flow is blue, the blue line, the RSI is black. What the money flow index is a volume weighted RSI. Volume weighted RSI. And so when you see the money flow index moving up like this, well above the RSI, that means there's inflows. There's money flowing into the Canadian dollar. And that's bullish. And many times you'll get to a peak like you do here, and the money flow will be well above the RSI. But then when you get to this peak over here, The money flow is not as high above the RSI, and sometimes will fail to even move above the RSI at this juncture. And notice that commercials were heavily short here, and we got this move to the downside. Hang on. So there was kind of a bearish condition right here, and it went down. Then commercials are heavily long, retail heavily short, bullish. But right now, this is bullish. Commercials like it. They like it a lot. Even though it's kind of building this sideways structure, this is probably going to be a 1-2, 1-2, and going to move higher. So this is bullish on the Canadian dollar. This is one of the best examples of how important it is to track commercials. So during this latest rocket ship move up, remember all they were talking about, they would on propaganda financial TV was people that were coming in that were super bullish on copper. They were still saying all of that slightly after this peak. Notice that all those people have disappeared off of television. Commercials have faded this move all the way, and we're hedged. Retail got up to 88% of retail traders bullish. And so when this red candle happened in late May, that was a major reversal candle. Also, see this tan line right here? That means that the ADX indicator was over 60 on a weekly chart. It doesn't happen very often. It was so extremely overbought, and now we're getting this massive reversal. So this system worked beautifully in pinpointing exactly when that thing had topped. It was right after this candle here. Corn right at the moment is actually bullish. We have commercials heavily long, retail heavily short. That's a bullish condition. It's sort of making a double bottom here. That is a bullish chart for corn. Crude oil. Crude oil is bearish right now. Commercials are heavily short right here. Retail was heavily long. 88% of retail traders were long here. That was a perfect storm of bearishness. First red candle inside that red box. And they were right after some little triangles here. Perfect. Bearish. It went on down. Now we got a little bump here, but notice the commercials are very quickly returning back to fully hedged. So the commercials on crude oil are easy. It's the oil drillers and integrated oil companies, anybody involved with the production and sale of crude oil, they are bearish. They are protecting themselves right now from lower prices. And they were within an eyelash of being fully bearish. You see how so often these critical junctures would assist a trader? Here's another a negative thing about this. So there's still, even though the retail traders were at 88 here, on this rise here, they're still pretty bullish at 72. This has plenty of room to the downside. And notice the money flow is severely lagging the RSI, and that means that there's money flowing out of crude oil right now. Gold. What do you think? Now that you've seen me show a number of charts here, is this chart bullish or is it bearish? Anybody? Just use the chat. Use the chat. Lee says bullish. No, it really isn't, Lee. I know there's a lot of people who like to believe that it's bullish, but it's not. The reason is commercials are heavily short. Retail traders were recently in 87 very long. This was a perfect storm of bearishness. The fact that the gold is trying to move up here, and I'm sure some are saying that it's trying to break out, but there's nothing on this chart, I mean nothing, that suggests that this attempt at a breakout is going to work. It's probably going to fail. The reason is because, and we also are just off of one of these dark red stripes. So on the money flow versus RSI, the dark red stripe, the dark red zone comes in when the money flow is lagging the RSI while the RSI is in its overbought territory. And in the case of RSI, that's an over a 70. The money flow was under it. So the money flow was lagging the RSI while it was overbought. That is not a good sign into this top. And now we have, look at the money flow indicator. The money is flowing out. So this is not bullish right now on gold. Here's one of the more bullish actually charts that you'll see as I show you through these weekly sentiment conditions. And it's on the Japanese yen, which has been ripping lower, and has many people, claiming that it's going to collapse. The Japanese yen is going to collapse, and they start using real exciting words like collapse. Just like some people, when something's like the Russell lately, it soared, and these are not terms that really need to be used when you're using a technical analysis. There's no need for these colorful narrative words. But anyway, commercials are heavily long, retail's heavily short. This is bullish, the Japanese yen. Natural gas recently had a full-on bullish storm, but that was back in April, and we got a nice spurt out of it. We had money moving in to natural gas long. We had only a 17% retail traders short, commercials heavily long, so that was a perfect storm. But that topped here, and it's been coming back down currently, but that was an excellent signal of what was going to happen next. Okay, the Nasdaq. So we've been getting some very high retail readings. We got an 88 recently on the Nasdaq. However, and another bearish thing besides the retail chasing this thing like crazy is that we've seen volume drying up, volumes coming out of the Nasdaq, and we saw this warning zone, this dark red zone where the money flow was riding below the RSI while it was above 70. And all of that was a warning ahead of this most recent move to the downside. All I'm telling you, Richard, is that it's the most critical junctures are when commercials are hedged. So what commercials were doing during during this period right here, commercials were hedged. They didn't think the Nasdaq was going to keep ripping higher here. So they're not perfect, but they're not chasers. They fade the markets on strong trends. So so the question is, we've got two very bearish things showing right here. We have volume drying up recently. We have retail very long, but the commercials are not fully hedged. On the Nasdaq, they would need to be moving down below this red line, and they're not. So this is not a perfect storm of bearishness on the Nasdaq, and therefore, and this is one of the main things I wanted people to get off of this first section of the webinar is the whole idea is to look for what's the cleanest setup on the sentiment. And it's not shorting the NASDAQ. I can tell you that right now. That's not the cleanest setup. Um, that doesn't mean the NASDAQ won't continue lower, and I'll show you my wave counts in a minute. It's just not, this most recent period of time, and we saw this same phenomenon in the S&P where commercials remained hedged while the S&P continued higher. Now, commercials will do that. But at this point up here, they finally gave up. And you'll see this once in a while to where the commercials are building a position against a strong rise, but it keeps going up. And then they give up and they remove their hedges. It becomes too costly. And when you see that, you're looking at something that at least recently has not been that clean of a situation. That's the stock market this year has not been clean as far as commercials versus retail. In previous years, it's been fine. The commercials were hedged here for a move to the downside, and they got it. Commercials were hedged here. Retail traders were 93% bullish. That's the best signal. That would be in November of 2021 of a perfect storm of bearishness on the Nasdaq. And then, and on the other side of the coin, in October of 2022 was a perfect storm of bullishness. Commercials had taken off all their hedges. They were buying like crazy. Retail was down to 5%. Only 5% of retail traders were bullish. This was one of the best buying opportunities. That's in October of 2022 we've seen in recent years. So these signals were working. But here lately, and even though it got extremely overbought there in January, the pullback only came down into February, and then the market continued higher. And you can just tell by their positioning that surprised many commercials. There's a lot of significance to this red zone here, Kevin. The significance is that there's money flowing out while and so that's a money flow indicator, which is a volume weighted RSI. And so this is the regular RSI. So the regular RSI was in overbought territory leading into that November peak in the NASDAQ of 2021. So the RSI was overbought, but the money flow was severely lagging. It's a huge warning. And at the point after a dark red zone that you get this big pink stripe, means that after that phenomenon, the RSI moved down out of overbought territory. And that was one of the best signals. And that's really the last time we had a pretty significant dark red stripe on the money flow. This is my custom designed money flow versus RSI indicator. But we just got that again. We just got it again leading into this peak. And now we have the RSI just this week moving down out of overbought territory, and it threw up one of these peak stripes again. So yeah, it's a warning sign. Palladium. You notice on this one, commercials have been liking palladium for a while, but it just kept going down. Retail hates it. And so this really, this chart hasn't really been working. So, but we still keep it. And so that the subscribers can decide which of these charts are working well, which are not, which are working normally and which aren't. So on platinum right now, we have a bearish condition. Now, it's my opinion that with a completely bearish spread showing up in platinum, copper, and silver, that we're on the cusp of a recession. But you don't have to come to that conclusion if you don't want to. But This is just a matter of reading the charts. Commercials are fully hedged. They think prices are moving lower. Retail's at us recently at 77, which is about as high as it's gotten over the last couple of years. That's bearish on platinum. Silver, bearish. Commercials are hedged. Retail traders recently, right here, 90% of retail traders were bullish. Look at the money flow. There's money flowing out of silver, and silver was extremely overbought here. So we're still in a bearish condition on silver. Soybeans. So commercials are heavily long, retail heavily short. That's bullish. As soon as we get a green candle within this green box, we don't have it yet. And the reason is because this 3-period moving average of the DSI hasn't started sloping to the upside yet. But that's rather imminent. So I've made this note on the chart. The next green candle will be bullish. The S&P. Notice that same red stripe down here, same condition where volume was coming out of the S&P. There was recently as much as 87% of retail traders that were bullish. And the odd thing about the activity this year has been that commercials have generally preferred to remain hedged. Now, if you look back at previous situations, we had a perfect bearish storm in February of 2020. Commercials were heavily hedged. Retail got all the way down to a 5 on that COVID plunge. And very quickly, the commercials aggressively bought that bottom. And it was a perfect storm where commercials wanted to buy, retail had thrown in the towel. When was the next critical juncture? It was in November of 2021. Commercials admittedly started hedging here. They started building hedges against this rise. That's what they do. They build positions against mature trends, knowing that at some point it would revert to the mean. And I think that answers your question, Richard, from earlier, Richard Wilson. At the same time, retail is heavily long. As a matter of fact, right here, 93% of retail traders are heavily bullish. Well, that's a perfect storm. We also, a third clue is saw the money flow going out during this last rise here, even though the RSI, which is only about price. So the money flow takes into consideration volume, money flowing in or flowing out. Whereas the RSI only looks at price. And so we got one of those big, that was a perfect storm of bearishness. And notice as the stock market started going down, we saw the commercials started accumulating long positions. And by the time it got to October of 2022, they had accumulated a lot of long positions at the same time as retail traders threw in the towel here. There was only 5% retail traders bullish here. It was the perfect storm of bullishness. So we went from the perfect storm of bearishness here to the perfect storm of bullishness here. And that everything looked good until about in here, and commercials started hedging. That was in August of 2023. Retail had gotten all the way up to 85% bulls right through here. But there was one thing that continued to be a little bullish about it, and that is that the money flow indicator stayed above the RSI during this period. And then, then between October of 2023 and the year end, that's normally a period of bullish seasonality, we had a tremendous inflow of buying come in. And that was, excuse me. And so you saw the money flow rip way, way above the RSI right in here. And that propelled it higher up into March of this year. But notice in March, commercials got back hedged. They were thinking that might be it, and we get a bigger pullback at that time, but we only got a small pullback. Also, retail traders got all the way down to a 20 here. So they were just in that 4 weeks. Retail went from the 80s down to 20%. But notice the money flow. It stayed above the RSI until when? Right in here. So this is the most convincing warning of a top that we've seen well, since November 2021, where the money flow is running below the RSI while the RSI is in overbought territory above 70. Retail heavily long, heavily bullish, 87 recently, and commercials still wanting to mostly remain hedged. But right this second, it's still not perfect. We don't have the 12-month look back commercials fully hedged yet. So this is still, it's close. Most of the characteristics of a top are in place, but it's not absolutely perfect. Swiss franc. Well, Swiss franc is bullish against the US dollar, and it has been since May. So commercials heavily long, retail heavily short, lots of money flow coming in. That's bullish on the Swiss franc. And if it's bullish the Swiss franc, it is bearish the US dollar. This is the item. This is the item. I've been pointing this out to subscribers for the last couple of weeks, that it's the most convincing position as far as commercials versus recent retail positioning that I see for potentially a fairly extended trend to the downside. So this is bearish the US dollar. This is one of the better setups. Look how quickly the commercials went from bullish the dollar to bearish the dollar. There was only a couple of 3 weeks in between where the commercials very quickly, and the commercials don't move quickly, typically. They moved from bullish the dollar to bearish the dollar. And that was shortly after retail traders were 91% bullish on the US dollar right here. And notice that is just about as high as the dollar went. So the US dollar is one of the better setups right now. And here's another one. This is amazing. So this is and I didn't even think of building a weekly a screenshot on the VIX until during the webinar last week when I built this chart, actually during the weekly webinar on Sunday. So notice commercials have all of a sudden shot up and they're heavily long. Retail very recently a 10. Matter of fact, by recently, I mean last week. Only 10% of retail traders thought the VIX were bullish the VIX. At the end last week, we had commercials in position heavily long for the first time since back here in August of 2022. That's right. The commercials were heavily long. The last time the commercials were heavily long, the VIX was in August of 2022. So this is a perfect storm of bullishness. Obviously, if the everything is perfect for the VIX to go up, that's bad news for the stock market. Wheat is really nothing. It's more bearish than anything, and that is all of those charts. So I want to take time to show you what the premium plan members get to see every Monday. That's all of these weekly sentiment screenshots. And I think you'll agree with me that it's pretty easy once you get used to watching those to see where these critical junctures are. I also will occasionally flash through those and show them during the weekly webinars. I've especially been doing that some lately. Um, and so the next thing I want to show are we're going to move to the algos. We're going to move to the algos. So I'm going to start up Trade Navigator again. And move this over here. Okay. So we're going to talk about some of the algos. So for this algo, I'm just going to use I'm going to use the either the Dow Jones Industrial Average or the S&P. Frankly, I'll probably show both of them to you here. So while I'm waiting for that to come up, I'm going to show you there's something called equity curves. So when I build an algo and I back test it and optimize all the settings on the algo. So we'll start with the YM contract algo on the Dow Jones Industrial Average. And so the algos are strictly based on momentum. There's no Elliott wave, no Hurst cycles here, but there is a little bit of sentiment built into some of the algos. The sentiment that's built in is the daily sentiment index. In the case of the Dow Jones Industrial Average, their daily sentiment index statistics are not published on that one as part of that service. So maybe we'll go to the ES contract instead. On the ES contract, the daily sentiment index is published on that. So tonight after the close, right here, it says 69% of retail traders were still bullish on the S&P. These big green blocks, those are winning trades. Notice on the algos, on every one of them, I put the same money flow index versus RSI because it gives such awesome information. The dark green blocks are winning trades. Well, you'll notice something. There was a period of time where the algo, the momentum algo, even when the S&P was moving up during this period here, from January of 2024 in a straight line up through late March of this year. And yet the algo wasn't able to really make any money. Not, there's the red block here is a losing trade. Green block is a winning trade. Can anyone look at that price action and tell me why they think the algo wasn't, which is a momentum algo, wasn't able to make money while the market went up in this channel? The answer is because every few days is the daily chart. There was a dip, 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 and it's constantly stopping out the momentum algo. So if you ask me, this price action is some of the strangest price action. I'm talking about from January of the beginning of the year on through late March, some of the strangest price action I've ever seen in the whole time I've been designing these algos. And the S&P is rather noisy anyway most of the time, and so sometimes I'll have someone come in and subscribe, and they want to take each and every S&P trade because that's the thing they've been focused on. So a lot of what I'm doing today is I'm showing you, guess what? The S&P is rarely the best trade you can make out there. There's lots of things to trade, and sometimes the S&P is not the best item to trade. And I'm going to show you our sortable spreadsheet right now. And this, after doing the back test on the algos, the momentum algos, Once again, this is about 4 quarters in a row. The winner is gold on the return, the 3-year return on investment sorted. So what that 3-year return on investment is it assumes that you start with an account size of a certain amount, and that amount is determined by the back test. So if a person was going to trade one GC futures contract at a time, either long or short, whatever the algo said, and you started with $21,796 exactly 3 years ago in your account would have grown by $117,000 additional dollars over that 3 years. That's trading one contract at a time. That's a 540% return on return on investment. Why 21,796? Because that's how much you needed to start with in order to not get margin called at some point along the way. Because there's going to be winners and there's going to be losers. During that 3-year period, there were 5 consecutive winners, and during probably the biggest drawdown period, a drawdown of $10,000, 766, there was 6 consecutive losses at one point. The winning percentage was just a hair under 50%. However, here's the key. The average winner was $4,759, and the average loser was $1,582. And what that means is the way gold moves is when it gets into a trend, it stays in a nice trend for a while. And so all of my algos are designed to let the winners run and cut the losers short. That does not create large winning percentages. What it does is it creates a huge and excellent risk to reward ratio. This is, in my opinion, the proper way to design an algo. Now, you'll see people designing algos that have a 90% win rate. Well, in order to get a 90% win rate on an algo, you'd have to have like a take profit target of $100, but you need $1,000 stop in order to trade that way. So that's a terrible risk to reward ratio. And what if you take profit on $100 fixed target, and it just keeps going up or down, whichever. But anyway, gold's the best. So look, S&P's way down here. The Dow actually rates a little higher. So I'm going to go back to the Dow. We'll go back to the Dow, which has some bigger winners in it. So the big green blocks are theoretical winners. Had the current settings been in place for the last 3 years, it would have had a winner here, a winner here, a winner here, a loser here, a loser here, break even, and it'd be on a winner now, but it's getting really close to suggesting exiting that trade. Notice that it also, even the Dow had a hard time from January through March making any money because of the constant dips that were happening. Now, there were some huge winners before that. There's big winning a long trade, big winning short trade, winning short, winning long, a huge winner on a long trade. So one YM contract, trading one YM contract, that winner right there would have made $11,430, just as an example. So I can tell by looking at these charts that the YM contract is the better contract to trade than the S&P, but it's still not the best. So here's how the algo works. There's an adaptive moving average. Perry Kaufman came up with this, and he's an automated trading, algo creator, and designer. And it's sort of a modified moving average. And so sometimes it's sloping up, sometimes it's sloping down. When it's sloping down, the algo is interested in only taking short positions. When it's sloping up, the algo is only interested in taking long positions. However, that's not the only deciding factor. There's another indicator here I call the Walter Bressert, an early pioneer in indicator creation. What the Walter Bressert actually is a double smoothed RSI. It's very simple. So this is a double smoothed RSI. And what he suggested, Walter Bressett, is put a moving average on that, and then trade the crossovers. And so I also use that. So when this indicator, when this crossover agrees, like right here, we got a crossover right here. That's when there's a crossover, we get a green block. And it also puts a green block up here. If, when that crossover occurs, the adaptive moving average is sloping to the upside, then it buys. It buys typically at market the next day, the open of the next candle. And then it has an open price objective. It lets it run, but when the Walter Bressert starts to slope down, that is a clue that it's of when, and that's what these little red arrows are, the algo starts trailing the stop. And I test for the initial stop size for longs and the initial stop size, fixed stop size for shorts. And I also back test for the optimum trailing stop size. So when it at the point that it does suggest a trail, how big that trail should be, and also to test for the size of the trail for short position. And what you end up with is you end up with big winners, for enough big winners to more than offset the smaller losers. Can anyone imagine why the losers are always small, but the winners are usually larger than the losers? It's because we use a protective stop. It's because we utilize a protective stop. So that's the way the algo works. It looks for the agreement of two classic indicators in order to take a position, either long or short. However, when it exits, it uses usually the fastest of the two. So in this case, that red block right there meant that we got a crossover, the Walter Bressert and its moving average. Oh, and by the way, I back test for it, that moving average, anywhere from a 3-period moving average to 25-period moving average. So I back test that. I back test 2 of the 3 parameters within the adaptive moving average and optimize all of those. As a matter of fact, you want to see all the things that I optimize for. I'll go here to edit this strategy. And we'll look, and there's all the parameters that I optimize for. I also have it determine, is the signal candle, is it larger than normal? And if it is, then I back test for how much of a pullback to look for before getting back in, because usually when you get a real long signal candle, there's at least a partial pullback the next day. I test for that, and I also on the any item with the DSI is involved, I back test for how high If the daily sentiment index gets X amount of high, is it no longer profitable to take a new long trade? And so there's thresholds. So if you get a new sell signal, but the DSI, the daily sentiment index, is like 8, only 8% of retail traders are bullish, you probably don't want to short there. And I have that built into the algos, at least the ones that have the DSI, where it won't, at some point when something gets that stretched, it will quit chasing it. In other words, so I have oh, and notice I'll just show you very quickly the once we I test for all of those parameters, and I'm on the YM contract, and I test from July 1 of 2021 through the end of June 2024. So it's the most recent 3 years running. And I also figured that it charges a commission, a round term commission for for the contract. That's all built in. Then when I run run it, it comes up with these stats. And so in this case, those stats. Let's see if I can get those back up here. Says it brought in $80,616. And those stats, I take those manually and put them in these boxes, information boxes on each algo screenshot. So this is a July 1 back test. Over the 3 years, it's traded 79 times. There were 36 winners, 43 losers. The average winner was $4,297. The average loser was 1723. Net profit 80,616. The count size required 23,739. Most consecutive wins, most consecutive losses, and all of those items are statistics are also placed in our sortable spreadsheet so we can see which algos are doing the best. So here is the equity curve on. So had these settings been in place for the last 3 years, and I will represent to you that in most of my algos, the settings don't change hardly at all from one quarter to the next. They might change very subtly, but the general concept is very, very similar. Some of them, many of them, I'd say half of them, that settings don't change at all. So in a way, in some of these items, these results aren't theoretical. They actually occurred. But please do consider them to be theoretical, because these are back tested and optimized settings for these indicators. And you can see that if you just turn the algo on, the very first thing that happened is it got some drawdown. But then during the year of 2022, it went up substantially. And as you'll recall, that was a very bearish year. It also, so it was making its money mostly on shorts right there. And then 2023 is also very good. But so far this year, it had a drawdown, and then now it's pulled back up. So I would call that a decent equity curve, but not perfect. Not perfect. And you can see there's the equity curve when going long. Here's the equity curve when going short. Notice that obviously it made most of its money going short during the bearish year of 2022. Not so hot going short ever since. And so we combine all the trades. So what I've got here for you is all of the algo equity curves, and we're going to look through them real quick and see which of these, and I'm going to post these and as a matter of fact, they were posted tonight for premium plan subscribers, so they could look at them. So here's the equity curve, and then on the Australian dollar, not really good at all. Here's the equity curve on Bitcoin. Not smooth. It went through a full year of losing a little bit of money, waiting for the next time it started working again. There's the equity curve on the ZB contract. That's the 30-year bonds, and that is really good. That's an excellent one. It's very smooth, very little drawdowns, maybe some sideways periods, but that's one of the best ones, ZB contract. Here's on this is G6C, this is Canadian dollar. Not that great. This is crude oil, pretty decent actually. Trading on crude oil. One big drawdown right here, but other than that, pretty solid. This is the German DAX, pretty decent, but a long period, sideways period here. This is the YM contract. So this is the Dow Jones Industrial Average. Pretty good. Not so great during the first bit of this year. That was that move up from the start of the year through May, and even though the market was moving up during that time, it was really behaving oddly with a pretty sizable dip that was bought up, but it would happen about every 3 days, and it was hard for momentum algos to make money on that. This is EEM, not that good. Euro, not really that good. GDX, this one's really quite excellent. Very smooth curve. And another thing about my GDX algo is you could take those very same trade signals and apply them using Nugget or Dust, the 2 times bullish or bearish GDX ETFs. This is gold. Gold has been doing really beautifully well for a long time until very recently. And this little pullback we're getting here recently on gold is due to the fact that gold's been moving sideways for a few months. It hasn't been moving, trending strongly. It's been chopping sideways. This is the NQ contract. Not great. This QID, that's a leveraged Qs. QLD, leveraged Qs. Pretty good on both those. Russell, not great at all. SDS, leveraged short S&P, pretty decent. Doesn't trade that much. This is the silver. So the algo's been doing especially excellent on silver. There was only this one little about 2 month, 3 month period of just sideways, but for the most part, silver's been making good money all the way. Started at zero, $150,000 worth of profit over 3 years, and that is why on that sortable spreadsheet, silver rates very high. This is the ES contract. And it had a really good 2022. That was the bearish year on the ES. But in 2023, it did manage to eke out some profit. But look at it so far this year. It's not that great. That's why I say just because the S&P is the only thing and the Qs is the only thing they talk about on propaganda financial TV doesn't mean that's what you should be trading in your algos. As a matter of fact, you probably want to be trading something that isn't constantly being talked about and gamed. XLE, for the most part, pretty good, but really hasn't gone much of anywhere for the last year and a half. This is XLF, quite a bit better. So on financials, a much smoother curve. So there are things, and that's the whole group. There are algos that do very well on the sortable spreadsheet. Bring that in one more time. And so you can test, look at, you probably, if you're going to trade algos with my system, you want to trade gold, bonds, silver, mainly. Maybe get just gold and bonds. Or maybe just gold. Or maybe you like the look of the silver when it's up in the top part. You like the smoothness of that equity curve better. But the S&P, and many of these things, they're on down the line. So I've explained the algo and shown you the sortable spreadsheet as well as the equity curves after backtesting and optimization. And so now the time has come to go to kind of what I do typically to show you what my weekly counts webinar, which is for Pro Plan and Premium Plan subscribers, how that typically rolls. So I would have just ended with the disclaimer, and then I'd start going into the wave counts on Dow Jones Industrial Average, S&P, NASDAQ, and Russell. So here we go. Long-term chart on the Dow Jones Industrial Average, no change. There's still 3 large degree Fibonacci targets up here. The lowest one, the big news is that the lowest one, I believe, now has been hit. So this very tight zone, Fibonacci target zone up here, we finally gotten into the bottom part of it on the Dow Jones Industrial Average. Compare and contrast that with the S&P, where when I do those same Fibonacci targets on the S&P data, all 3 of those have already been hit. But on the Dow has been lagging a bit. So the general idea is that the supercycle wave 4 that ended in 1932 has been followed by a 5-wave impulse. So we're looking for the end of 5 waves up from the 1932 low. 1, 2, 3 in 1966, 4 in 1974, and then a heavily extended 5th wave. Within the 5th wave, 1, 2, 3, 4, 5. The best target for the end of the 5th wave, looking at cycle degree or teal, is where the highly extended 5th wave would be equal to the net traveled from the beginning of the pattern through the end of wave 4 times a very extended 1.618 on a similar chart. And that is at 41,020. And I think that level was hit within recent days. We'll see that as we move into the lower time frame chart. So there's the 5th wave, the most long-term 5th wave target I have for you. Also starting at the 1974 low, 1, 2, 3, up through the year 2000. That wave 3 was heavily extended. It was 4.236 expansion off the top of wave 1, almost exactly. Then an ABC for a wave 4. That wave 4 was almost exactly a 0.236 retrace of the entirety of wave 3. So these Fibonacci's, are very close on this peak and on this trough. So we would look for a normal 5th wave in burgundy or primary degree that would subdivide into 5 waves up into this high. And the best target for the end of a normal 5th wave, and we would only look for a normal 5th wave here because we already got an extended 3rd wave within an impulse. One of the odd numbered waves of the 5 waves is typically extended in the stock market. It's almost always, not always, but almost always the 3rd wave. So that target's a 41,981. That hasn't been hit yet. And then within this move up from the March of 2009 low, 1, 2, 1, 2, 3, 4, 3, 4, 5. So this 5th wave up, so that would be up from the 2020 low in black. So this intermediate degree 5th wave up, best target, since we've already seen an extended 3rd wave, would be normal. And wave 5 would be equal to the net travel to 1 through 3. That's 1 through 3 times 0.618. That's a 43,652. And that hasn't been hit yet. So the question for a long time is, how are we going to get 5 waves up from the March of 2020 low? And I have never thought that this peak in January of 2022 was going to be as high as the stock market would go because it didn't get up into those Fibonacci target ranges. It fell short of those. Also, when you look at the way that move up is structured, it counts best as far as the Fibonacci relationships between A and C as an ABC zigzag. And so because that move up traveled almost, I'd say about 80% of the way to that target zone, I have been calling that a wave one of an eventual ending contracting diagonal where most of the move had already happened. And then when you get a wave two and a three and a four and a five, by the way, I'm going to change this just a hair. So I think we've probably seen waves one, two, and three of the diagonal now, and we need a wave four and a five still to go. Weekly chart. So the reason I think this was an ABC up most likely from the March of 2020 low through the January high of 2022 is because wave C was almost equal to wave A if you put the wave A here. 1, 2, 3, 4, 5 for A, and then B, and then 1, 2, 3, 4, ending diagonal for 5. You can see how very close that C wave came to equality with wave A. So I still, to this day, think that that was probably an ABC zigzag for wave one of a diagonal. Then wave twos of diagonals are typically deep retraces, but this one was not typical. It was shallow. So A, B, C for wave two, it was only about a 0.382 retrace. Typically wave twos retrace from more like a 66 to 81%, way lower, but that one did not. And then we get an A, B, C zigzag for wave three and is very likely complete very recently within the last couple of days. This the final move up needs to count as a 1, 2, 3, 4, 5. And I believe that this what we saw here was a wave four triangle and a terminal thrust out of that wave four triangle. Then we had the terminal thrust. Now we would need a wave four that would move down into the price territory of wave one because wave fours of diagonals must retrace into the price territory of wave one. So it must move below this pink dotted line right here. That is at 36,952. And it would need to carve out an ABC zigzag. And then there would still be a fifth wave up yet to come. Moving to the daily chart. I'm moving a little faster than what I typically do in the webinars. So there's the five wave up structure. This was a triangle, terminal thrust out of the triangle, probably finished. Notice there's that first long target for the end of the extended fifth wave up from the 1974 low right there. And that was hit here in the last couple of days. So this wave four would need to be an ABC. ABC down through probably late August. So I'm getting a question about the dates, the Hurst cycle dates. So the Hurst cycle dates are constantly adjusting to ongoing price action. These aren't fixed cycles like the moon. So a moon cycle, they can print on calendars years ahead of time and think that they aren't fixed cycles at all. Same with the FSC cycle program. I use two cycle programs now. I use Hurst, and Hurst fits everything into a pre-designed model. Whereas the FSC cycle tool is completely different. It looks for the most repeatable and strongest cycles, and then it only takes those into consideration. And it doesn't try to force it into a pre-existing model. So the pre-existing model on Hurst is that within each 4.5 year cycle, there are three 18-month cycles. So from the March of 2020 low, the first 18-month cycle, the second 18-month cycle, the last 18-month cycle, and that makes for a 4.5 year cycle. Longer term, within each 9 year cycle, there are two 4.5 year cycles. And I'm not going to go too much into depth into Hurst here, but it is a completely different methodology, and it adjusts. So the reason it adjusts is, for instance, if this is a 4.5 year cycle, you're going to get a 20-week cycle, and then you're going to get another 20-week cycle, and that's going to complete a 40-week cycle. Now, Hurst might decide, okay, well, this 20-week cycle, and it might decide this in real time, must have happened here. But then you get a dip the next bit. It's like, okay, that must be the 20-week. It's coming in a little later than typical. And it places the 20-week cycle trough there. And so that's the adjustments that it constantly makes. Is it's within the shorter cycles, and we'll move into the daily on this. Okay, so if this is a 4.5 year cycle, you get an 80-day cycle, and then you get another 80-day cycle, and that constitutes a 20-week. Then you get another 80-day cycle, and another 80-day cycle, and that constitutes a 40-week. Now, here's a perfect example. Hurst is calling this an 80-day, and I'm fine with that, and this a 20-week, and I'm fine with that. But it's calling this an 80-day. Well, I think that 80-day probably belongs here at the end of the triangle. Now, I could force pin it there, or I could just let Hurst do its business and then adjust it as Hurst adjusts it. It's a computer-based system. And then use the FSC cycle tool as sort of a tiebreaker. And notice that Hurst was thinking that this would top around July 17. The FSC cycle tool was expecting this to top around July 29. So that created a window for a top here. And then when you're moving down, Hurst currently thinks that it'll move down through August 8, but FSC cycle tool thinks it's down through August 24, and that creates a window down here. And then what I end up doing is using my little noggin to kind of come up with and look at the internal wave structures and come up with a Elliott wave roadmap that works in harmony with these cycle tools. Believe me, there's a lot of head scratching going on. But over time, over an extended period of time, I generally am able to build wave counts that I don't have to change nearly as often as when I was using Elliott wave all by its little self. Now, you might say, well, Sid, you thought this was the top. And I get this kind of thing all the time. Hey, Sid, you thought that was the top, but it wasn't, was it? Huh? You were wrong, right? Well, yeah, I did think that was the top, okay? And the reason is because that looked like the finish of an A, B, C zigzag, for one thing. And then also, the only requirement I had for this wave 3 of this diagonal is that it be shorter than wave 1. Well, it could go way further, higher, and it would and still not be as long as this wave 1 was in blue here. So Um, so I will use the cycle tools as best I can to come up with where these uh, turns are going to happen. But guess what? Nobody's perfect. However, I still am on this ending diagonal idea and have been for 3 years. It's just a matter of, when is this going to complete a 5-wave up structure from this October of 2023 low? And this happens all the time. You think it's over, but then it puts in a triangle and it's got one more little shoot. I'm afraid it happens pretty often. And it had already hit the best Fibonacci target here for the end of the wave C in pink. It just extended on. It happens. But generally, I'm still using the same count. It is a diagonal count, and diagonals are unusual and they are weird, and they can get weird and weirder as they continue on. And the thing that's weird about them is, even though in a diagonal, it generally making its way higher, each leg of a diagonal is a corrective structure. It's an ABC zigzag. So anyway, there's the daily on the Dow is that I think we probably started into this move, and it's got to move down below this pink line right here, because that was what it needs to do to move down into the price territory of the wave one. So the only requirement is over the next several weeks that Dow drop down below 36,952. And I just think there's probably going to be a ton of buy the dippers ready to go right there for this final push up. And here's a kind of a funny thing about it. The FSC cycle tool is thinking that the top is on the Dow is going to come in on approximately November 13. Well, these cycle tools have been suggesting we're going to get a top around the time of the election now for months and months. If you go to my YouTube channel, you'll see that. First started talking about this quite a few months ago. Also on the YM contract, we look at the trend. So this is a chart that even at the $25 level, you get one of these trend charts on about 12 popular items every night. And this is strictly a daily trend system on when the daily trend is down and when it's up, when it's down and when it's up. And the daily trend is currently up. And the reason I can tell is price is still contained in one of these green buy zone boxes. When a pink zone box starts to form, then you're in a sell zone. It's very actually deceptively simple chart, but some people have found it easier for them to understand and easier for them to trade directly off of these daily trend charts. This is the algo I already showed you. It's within an eyelash of wanting to take profit. As a matter of fact, if this is the current futures candle, it's forming right now. It's not finished yet. So it's saying that if today's candle, the Friday candle, ends at where it is now or below, it's going to be a crossover of the Walter Bresser and its moving average, and it's going to suggest getting out of this trade, getting out of this long trade. But it hasn't decided that yet. And the reason is that isn't a daily close chart. It's still streaming. This is the daily sentiment. So I showed you a bunch of weekly sentiment screenshots, but the premium plan people get the daily ones too. The daily ones might, especially when used in conjunction with the weekly ones, allow you to time in these critical junctures where you can see the commercial's positioning versus the retail positioning. The thing that's different about the daily sentiment conditions is that it has three different ways to measure commercials positioning. One is as a percent of open interest. So this is a Larry Williams concept. He showed how to code this in Trade Navigator in a book about 20 years ago. So there it is. And what that basically means is that that's a very fast acting commercials positioning indicator. It's the fastest one that we can create. Larry wanted to come up with something that would work even faster than the weekly COT report, which comes out on, I think, Tuesdays. Notice that on 6-month look back, commercials are still, fairly long, but on a 12-month look back, they are hedged. So for the most part, this is bearish, but the 6-month look back isn't in perfect position yet. Also, on the daily sentiment screenshots for premium plan subscribers, I show bullish and bearish seasonality on virtually every futures contract. So we're still in a period of bullish seasonality on the Dow for a few more days until July 23. Now, all seasonality really means is that 8 times out of 10 over the last 25 years, the Dow Jones Industrial Average closed higher on July 23 than it started on June 28. That's all. That's all it really means. So if you want to think of that as 80% of the time during these particular calendar days, the market goes up. That's what it means, and I find it to be worth considering, and that's why I put it on the sentiment conditions charts on virtually every futures contract. So now we're moving to the S&P. Same thing, same long-term count on the S&P, same long-term Fibonacci targets, except they've all three been hit now. The Dow's only hit the bottom one. Okay. But we're still needing a 5-wave structure up from the March of 2020 low in order to call it a top on this market. And I think we only have 3 waves. We would need a 4 and a 5. Now, I have seen some count this as a 1, 2, 1, 2, 3, 4, 3, 4, 5. However, I believe that Hurst analysis and the FSC cycle tool, which amazingly most of the time are in pretty good agreement on most items, think that there's going to be a dip and then a move up into essentially the election. So that supports the idea that we still need a 4 and a 5. This ending diagonal has been moving up from the wave 2 in an amazing fashion, and the reason is because since May of I first read this in May of 2024, so a couple of months ago. Since this low, there had been zero earnings growth in the bottom 493 stocks on the S&P. In other words, this entire move really mostly is because of 7 stocks, so it's very narrow. And it also has required P to E expansion. So the P to E ratio here was about 19, and it's up around, I don't know, 25 now. So it's required for people to give more money for the same valued stock over this entire rise. So these stocks have become more expensive, but their earnings really aren't deserving of the price going up like this. And so here we are at extremely elevated valuations, extremely overbought. So I think that we have just recently embarked on an ABC to the downside, and it needs in the S&P to move below the January of 2021 high, and we need that overlap in order for this wave count to be correct. Well, what if it moves down into this 40-week cycle trough, but it doesn't overlap? Well, then that's where this is a new alternate that I'm first showing to the general public, that would come into play. So what if this wave 4 cannot move below this dotted line right here? What if it can't move that low between now and late August, for instance? Well, then what I think is going on is that once again, the wave 1 up from March of 2020 low through the January 2022 high was in this case a 5-wave structure, but it was an extended wave 1. And when you get an extended wave 1, then wave 3 is going to be shorter than 1, and 4 or 5 is probably going to be shorter than 3, but you don't need that overlap. But what you need is you need each leg to carve out a 5. So 1, 2, 1, 2, 3, 4, 3, 4, 5, and then the correction of an ABC, and then a 1 running flat for 2, 3, 4. No, there was no overlap there. And then 1, 2, 3, 4, 5 to the end of 5 waves up there. And then you get an ABC down for wave 4 here. Does not need to overlap, and you still get a 5-wave up structure here. The main difference here is that it raises the Fibonacci target for the end of this blow-off bubble. It takes it all the way up to 6510. And I've come to that conclusion by figuring this was an extended wave 1, so I would look for the end of the 5-wave structure up from the March of 2020 low to only end at approximately a 5 or a 0.382 expansion of wave 1. So there's the best alternate if we don't get the overlap. Here's a daily chart of my main count. What I'm expecting now is an ABC zigzag to the downside. Hurst is when I force pin a 20-week to right to this low, that pushes this 40-week cycle trough target down into September. And that's pretty believable because August and September seasonality is really not that good typically. Matter of fact, September is often the worst month of the year, stock market wise. Then you get the end of the year, seasonality kick in, but according to Hurst, a combination of Hurst and FSC cycle tool, we would move down into September now and then get to that ABC to one last all-time high to best target 5784. No, wait a minute. Yeah. No, that's not, that was the best target for this peak, and I don't think it reached it. Here's the weird thing about this peak. Theoretically, it would need to make a new all-time high above the high we just saw. But in actuality, and this would be a very large cycle peak theoretically, if my larger wave count is correct, a grand supercycle wave 3 peak, if that is going to be the peak, then we could get a truncation on this 5th wave. So in an ending diagonal, wave 5 can truncate. It can fail to make a new high above wave 3, but it still would need to carve out an ABC zigzag pattern, but it might fail. So we might possibly have seen as high as we're going to see the stock market anytime soon. So, but the only way this can truncate, this 5th wave up, is if we get that overlap into the price territory of wave 1. And so that would be below 48.18 on the S&P by the time we get into September. Question comes in: how low does Elliott wave suggest that wave 5 of wave 5, etc., beginning? drop in November will go? Well, that's a really good question, Richard. And so we're going to go back to the quarterly chart on let's say the S&P. I can tell you this: there's a there's a Kondratiev 50-year cycle trough low due somewhere between 2032 and 2036. There was 1932 was that Kondratiev low. Probably 1982 was that 50-year low in the S&P and the Dow. So really 2032. And you know, here's I'm really glad you asked that question, Richard, because if you read any Prechter's books back 20 plus years ago, he was talking about a crash all the way back to the 1932 low. Well, yeah, here's the way I'm going to look at that. What we're going to see next is probably a grand supercycle wave four. And in a grand super, in any wave four that occurs, that could be any number of, it could be any number of Elliott wave corrected patterns. It could be a zigzag. It could be a flat. It could be an expanded flat. You could get a new all-time high during that wave four. It could be a triangle. It could be a running triangle where, once again, you could get a new all-time high during a triangle. So I'm not necessarily going to set a price target based on traditional Elliott wave. What I plan on doing after this November peak is utilizing the same tools, non-Elliott wave tools that I have been using, and that is Hurst cycle analysis, as well as the FSC cycle tool, as well as the weekly sentiment charts. These sentiment charts and the cycle analysis are going to be enormously helpful after that peak, because you look at a typical Elliott wave person, they're just going to go, well, I guess the market's just going to crash. I guess it's just going to crash, and it's going to be a huge crash. And then they're going to have to start counting the little fives and threes and what's going on. And believe me, I've been there trying to use Elliott wave and nothing else. And I don't think that's going to work. I think what is going to work is some of the most important things are going to be the weekly and daily sentiment charts. Yes, I'll be looking for fives and threes on Elliott wave, but also I'm going to be looking at what Hurst cycle analysis is expecting. And you'll notice that on this particular Hurst cycle analysis, after that peak, it's expecting that the next 18-month cycle trough will be in approximately April of next year. Now, that's helpful. That's extremely helpful information. And then I got to tell you, you look at the Hurst, and it thinks the market's going to stay up and chop sideways after that. In order for Hurst to change his mind and become more bearish, like I'm thinking as an Elliottician, it's going to need some serious downward movement in order to consider that that's the way it's going to roll. So I think that my service is going to be extremely useful after this theoretical peak, whereas I think traditional Elliott wave only counters will be lost. So we're done looking at the S&P. Let's see if there's anything else really quick. Here's an interesting thing. The daily trend on the S&P just turned to the downside. We hadn't seen a downtrend on daily chart on the S&P in a long time. That happened today. We're also on a sell signal. We hit a sell signal on the algo On Thursday, we're on a sell signal and it's in profit. It was a sell signal that entered in at short at the opening of of yesterday's. Uh, we're on a new futures candle now, so it would have been on the beginning of the Thursday candle. I already showed you the sentiments. It showed you how the ADX is over 60 on a daily chart. That's extreme overbought. Notice this low right here. This is in April. The ADX was over 60, oversold at that point. Notice that we have some serious interest in getting short the market from the commercials on this daily sentiment chart here. We didn't quite get a pink zone on the 6-month look back, but it's very close. And we had an 86 on retail. 86% of retail traders were bullish on this candle. Then within that big red box, we got the first red candle. So on July 11, we got the first warning on the daily sentiment conditions, looking for an important peak at the same time as we were in up here where the ADX indicator was over 60, extremely overdone to the upside. So it's not a perfect storm on the S&P of bearishness, but it is very close, as I had mentioned earlier. Here's another new development. So on the SDS algo, this is the 2 times bearish ETF on the S&P. No, we didn't get a buy signal here, but we did today get a buy signal on the 2 times bearish NASDAQ, and I'll show you that in a second. Look at the warning signs of a bottom on SDS. So this is the bearish ETF. It's warning of a bottom, and you're starting to see some money flow come in, so that you're seeing some hedging come in here in mass. This is one of my favorite charts and has been lately, and it shows how the market cap weighted S&P was rallying quite aggressively while the equal weighted RSP was falling away. And then we had this rotation that they're still talking about into the Russell out of tech, and it caused this massive spike up here. So we're going to talk about that as we're going to go on to the NASDAQ and the Russell next, as if I was going to do, as if I was in a weekend webinar. There's the next Fed days, by the way, that's coming up. So now into the NASDAQ and Russell. One of these days, I'm going to quit posting these recordings on YouTube on these quarterly premium plan webinars. And there's a lot of people that watch watch the recordings. And I wish they would just come in and be in here live, and that way they could ask some questions. So this is the NASDAQ composite. This is all of the stocks in NASDAQ, including a whole bunch of tiny ones that aren't included in the NASDAQ 100. It's still putting together about the same pattern. There is something interesting about this, though. If I've got this count right, and this is the way up from the October 2002 low, 1, 2, 3, 4, then the best target for the wave 5 is still on up there a ways. It's at 22,725. But based on cycle analysis and a number of other factors, including the internal wave structures of all these moves, I think that we're going to get the same pattern here as I'm suggesting is most likely in the Dow and the S&P, that we just topped in the end of a wave three of a diagonal. We'll move down an ABC structure to below the November 2021 low, and then have one more move up into approximately the election again. The daily trend on the all-inclusive NASDAQ composite just today turned to the downside. The daily trend on the XLK technology sector using my daily trend template just turned to the downside yesterday. That was on Wednesday. On the NASDAQ 100, this is the 100 largest stocks in the NASDAQ. Notice the same thing. I'm expecting an ending diagonal. I'm actually expecting it to probably fall a little short of a typical black wave 5 target because of this diagonal concept. So there's the ABC for one of the diagonal. It's also possible that this diagonal started back in late 2018. A, B, C for wave one, a very long wave, the longest in a contracting diagonal of 1, 3, or 5. And so then we got the fairly shallow 2, a corrective wave 3 to new highs, looking for that overlap move down for wave to below 16,764 on the NASDAQ next, and then a fifth wave up into mid-December on this one, separate Hearst. Here's the daily chart of the same. So down into approximately mid-August to below 16,764, and then up into approximately the election. Notice I'm using both the Hearst, that's the dark black, and the FSC cycle tool dates, turn dates, in order to come up with what I think is most likely. And it creates these zones, windows for peaks and troughs. The daily trend turned down on Wednesday on the NASDAQ, the NQ contract. We don't have a sell signal yet on the NQ contract algo. Remember, the big green blocks are the winning trades on the algo. The small red blocks are the losing trades. You can see that the volume on this weekly sentiment conditions chart, I already showed it to you moving out. We have retail extremely bullish, but we don't quite have commercials heavily short on the 12-month look back yet. But let's look at the daily sentiment. Okay, on the daily sentiment, so what I was showing you earlier was the weekly sentiment. The daily sentiment for premium plan subscribers shows three different measures of commercials positioning. And the commercials as a percent of open interest are now showing that they want to build their hedges. But the 6-month look back and the 12-month look back are still in the neutral zone. So we don't have a perfect storm here. We do have bullish seasonality through July 29, but I suspect that that most recent peak is going to be as high as the market's going to go, and we're going to continue this bearishness down probably into September. So QLD, this is our algo on the two times bearish ETF for premium plan members. They get an email every night that shows a full spreadsheet of show that to you real quick. Where did it go? Okay. So if you're a subscriber and you are a premium plan subscriber, every night you get an email and say everything's been posted and here's tonight's. And you go in there and Like I also put the equity curve screenshots in there tonight. That's happens once a quarter. But the nightly report has a summary spreadsheet in it, and it shows you buys, sells, and whether trade management is required. So the Dow was on a buy signal, but it recommends changing the stop to a trailing stop. In other words, tightening up the stop on that long position. Other new items. Okay, we actually got a buy signal on the QID. So this is this next chart. This is what I was going to tell you. We got a new buy signal on QID. The last time we got a buy signal, in other words, the last time this recommended getting short the NASDAQ was here, and that was on April 15th. And it didn't last very long. It lasted about 5 days. It did close that trade in profit. But boy, and then before that, I mean, you really got to go. You'd have to go back to, you know, September, October of 2023 in order to get any kind of signal here that would recommend shorting the NASDAQ. So this is a back-tested algo, and it's saying now's the time to short the NASDAQ. This one's going to be real interesting, and we're almost done with the webinar here, other than any questions that come forth after I finish these tabs right here. But this is the Russell. This is my count on the monthly chart of Russell. This recent up spike that we saw on the Russell, I think it's going to be very short-lived. I think we've already seen the top on Russell way back in late 2021. And that was followed by wave one to the downside. And ever since mid 2022, we've been in a sideways corrective pattern on the Russell, and it's going to give way to the downside. And yes, going to get a recession. And a lot of people say, yeah, but if the Fed cuts, that's really good for small companies. Well, no, it's not, because the reason the Fed would cut would probably because the jobs report would continue to weaken. The employment situation would continue to weaken. That would probably cause them to cut, probably in September, and it would be in response to very weak ongoing data. And when the jobs weakens, and we've already seen some signs of that, that means we're probably going into that long-awaited recession after all these bond inversions for such an extended period of time, a record length of time. And so, no, that's not going to be good for small businesses, because even if interest rates are a little lower, it's probably their business is not going to be good, and they're still probably going to have a hard time borrowing money. But anyway, you can see this is projecting a peak in September. So what's the pattern of this whole corrective structure? So I've got this as a 5-wave structure up in the Russell. Yes, I can show Bitcoin toward the end. 1, 2, 3, 4, 5. And then and then that peak occurred in November 2021. Then we got a 5-wave structure to the downside. And all of this junk ever since has been a correction. W, and then A, B, C for X, and then an A, and here's the important part, triangle. Triangle. So this triangle happened during the entire first half of this year. Triangles cannot appear alone in a wave 2 position. So this isn't a 1, 2, 3, 4, 5. We're going to break out like some of them were talking until today. Now they're backing off on it. It's incredible how just one day's price action will change what the talking heads on propaganda financial TV say. And they'll disavow ever saying the other part that they were saying, which is, oh, yeah, this is the great rotation into the Russell. Well, it's possible that the Russell isn't quite done going up yet, but this move to the upside, I think, is a terminal thrust from a triangle. Here it is on daily chart. So this is probably a five-way structure. This will be up from the October low of 2023. Then we got this triangle. It's a beautiful triangle. Perfect. And then a one and a two. And this is probably just wave three. I doubt that the Russell has finished the great rotation quite yet. That we'll probably get a long-lasting wave four, and then a five up and peak maybe in September. I don't know. Is it possible that that was all she wrote on the Russell and that's it? I'm going to go ahead and put a two question mark there because it is possible. And here's why. Here's why it's possible. Because when you have a triangle and you get a thrust out of the triangle, the thrust is typically very aggressive until it's finished. And you can see the last couple of days have been very weak here. So it's possible that that's it also. So if this is wave A, an eventual A, B, C pattern, there's two Fibonacci targets that I typically set. One is for the wave C to be a 0.382 expansion of wave A. So all of these Fibonacci's I draw on Similog charts. So this is wave, consider this a unit of one. Take that times 0.382 and add that product to the top tick here, and you get this line here. There's a 0.382 expansion of wave A. The next target I set, which would be the high target, would be a 0.618 expansion of A, and that's up there. And notice I'm still considering that it might get up there, and we could have this rotation. But this being a triangle means that once this carves out a five-wave up structure to the upside, it's done. It's done. I don't think it'll move to new all-time highs. It'll finish its pattern and then be very weak, according to Hurst, down into February of next year initially, a rebound into August of 2025, and then on down. This is what I mean when I say once the stock market maybe puts in this major large cycle peak, unless you are using some cycle analysis, I think it's going to be difficult for you to predict what's going to be going on after that, unless you're using some additional tools besides naked, pure Elliott wave. So see the kind of head and shoulders I'm projecting there. The daily trend on the Russell is up, although it pulled back quite a bit today. The algo is probably going to take profit on this move tomorrow. Remember, this candle, this futures candle, is not fully formed yet. It could move a lot lower or it could bounce a little bit, but there's a pretty good chance that the Ultra Brexit is going to cross over its moving average and it's going to exit. The algo is going to exit this trade at the close tomorrow, Friday, basically. The sentiment on the Russell, once again, not a clean, full-on bearish story. The commercials are long. They're as long as they have been at any point in the last 6 months, and they're as long as they have been for the last 12 months. So, and I would say that the rotation still has potential, but not a lot. And there's the algo. We have an algo running on the 2 times bullish Russell and on the 2 times bearish Russell. Finally, I end with the semiconductors. Notice that the wave count is very similar, expecting that we're in an ending contracting diagonal and that we have actually started the way forward to the downside, that we get an ABC up. For a fifth wave up theoretically pretty close to the election for the top there. So I want to let you know that during the webinars, then I move on and I show popular stocks. I show all of the Mag 7 stocks every week, and I should include those in the EWP screenshots for basic plan subscribers, the $70 a month on up. Also, I do complete analysis of the VIX, the put to call ratio, and the advanced decline ratio. I look at a lot of sectors like the XLE energy, XLF financials, and several more. I look at mining extensively. I look at GDX, and I look at some individual mining stocks and show them every week on Newmont and Barrick. I show the European stock indices of weekly charts on the DAX, FTSE, the Australian stock market, the Canadian stock market, the Nikkei, Shanghai, the Hang Seng, and EEM. Also, look at bonds. It's very quickly. I'm just going to show you on bonds. Remember how I told you that I didn't think bonds are ready to take off to the upside quite yet. I'm going to show you very quickly my wave count on bonds. Well, I'll use the TLT for that, and maybe the ZB contract. So on TLT, I think we're in a 1-2-1-2 scenario, and that it won't end until approximately August 28th. There is a Fed meeting in mid-September that I think will be the first time they cut. I think the reason they'll cut is because of employment weakening, and they'll go ahead and cut there. It it will be somewhat of a oh, it'll represent something, but it takes months and months for any kind of raises or cuts to actually make their way into the system. So it'll be somewhat of a symbolic cut, I think. But I do think bonds are generally going to work their way higher through late in the year. And that means interest rates will be coming off. And I think that the reason bonds will be rallying then, and here's the ZB contract daily, the reason bonds will be rallying is because people will be moving their money out of the stock market into treasuries as a flight to safety. So the next Fed meeting is late July, July 31. And I think that the market is attempting to front run them potentially raising they probably won't. And we'll notice the Hearst cycle dates here. And then we move down into late August. And then right here, they probably do cut. And that is all the market would need to see in order for bonds to move substantially higher. I just wanted to make sure you saw that. To let you know that just because on the sentiment, weekly sentiment chart on ZB, just because commercials are hedged right now, it doesn't mean that they can't very quickly, by the time we get to August, get into fully bullish position at the same time as a retail would move down lower into approximately late August. So probably going to go something like that, and that is your perfect storm. Commercials heavily long, retail pretty heavily short, bullish. There was a request for Bitcoin. For any of you that have followed me for very long, I'm not a big fan of Bitcoin. I don't think Bitcoin is a legitimate or sustainable way to save your money. And here's why I don't like it. It's antiquated. It'll never become a standard. It's too old. It's too slow. It eats up too much energy. I do think eventually we'll move to a crypto that will be probably useful as a currency. It probably will be backed by the worldwide banking cartel. It won't be independent, and it'll have some regulation. But as you can see, I'm bullish on Bitcoin based on the fact that Bitcoin made it a slight new high earlier this year above the highs back in 2021. So I'm up from the November 2022 low, 1, 2, 3, 4. It's time for the fifth wave up. My wave count is that Bitcoin will hit 100 grand. And that would be at the end of a typical wave 5. But after that, I'm telling you, you read this article. Why Bitcoin is fundamentally flawed. You could probably just Google that. It's Seeking Alpha. It shows how Bitcoin is probably unsustainable over the long haul, and I personally believe that Bitcoin will eventually go to zero. That it will become like a Victrola that played 78s. Nobody will want them anymore other than as a museum piece. I'm talking about the old records from 100 years ago. And that, I don't see why Bitcoin would be the chosen one. There's got to be something better. But yeah, could get this bubblicious move up into September, October on Bitcoin. But I think it's the final leg up of a very large pattern. So there's a wave 4 low back here in 2015, the end of a large degree wave 3, large degree wave 4, and then a 1, 2, 3, 4, 5. Best target 100,700. Any other requests for any other items before we call it? We've been running pretty long. I do want to show you an offer I have if you would like to subscribe to any of my plans. And for that, I'm going to bring up what my plans are again. It's at elliottwaveplus.com /pricing. And so you'll need to find this at my website. The way you find it is just from the home page. You tell it you're interested in maybe learning more about any of these plans, and it'll give you a lot more detail about what's covered in each plan. But you'll eventually end up here. Those are the 4 tiers of service. So please subscribe to one of our plans. Anyone who has not been a subscriber at any point during 2024 will receive a 50% refund off their first month. So, like, let's say you decide to choose the premium plan. It's $100 a month. For the premium plan, you get Elliott Wave screenshots on Sundays and Wednesdays. You get the webinar on Sundays. You get the recording of the webinar. Plus, you get the daily trend reports and everything prior to that. So subscribe to something. I'll give you 50% off refund off your first month. To receive the refund, 50% refund, email me, sid@elliottwaveplus.com. So that is everything I count. Thank you so much for joining me. It's been a pleasure to present for you. Thanks for sticking around for this long webinar. I hope that I can pick up a few new subscribers. Because of it, I think my work is unsurpassed in many ways in how complete it is, especially when you get into the premium plan. Thank you so much for joining. See you later. Bye-bye.